I am a fan of fast food chains like Tim Hortons and Burger King. Restaurant Brands International is the company behind them both, and that has me wondering if they are a great investment. Line up for the drive-thru, folks. This is going to be a tasty one. Restaurant Brands International, or RBI, is a Canadian multinational fast food company that came into existence not that long ago. In fact, the company formed in 2014 when Burger King and Tim Hortons decided to tie the proverbial knot. And that was a sizzling $12.5 billion merger. The new RBI family then expanded in 2017 when they adopted an American chain called Popeyes Louisiana Kitchen. That cost them a cool $1.8 billion. Then, of course, in 2019, they added Firehouse Subs for another $1 billion. Holy cow, they should buy me a gift. They seem to spend big. Now, with over 29,000 restaurants in more than 100 countries and U.S. territories, RBI is the fifth largest operator of fast food restaurants in the entire world. Join the conversation. Let us know in the comments your favorite menu item at Tim Hortons. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and thank you for that click. When we began to think about the investing potential of RBI, the first thing I want to know is just what do they currently have cooking over there? They do have a three-focus plan to expand the company and thus serve up a whole bunch more of their fast food chain offerings. First, they have a focus on strengthening their digital technologies. This is everything from their online presence, mobile ordering, payment, and of course the ease of delivery. Next, they are aggressively expanding into new territory. Tim Hortons, for example, has been absolutely exploding in the United Kingdom. Popeyes, they also have pretty good expansion potential. Finally, they are looking at updating the actual designs of their restaurants, adding things like digital menu boards, doubling up on the drive-through lanes, and adding curbside pickup, which of course was very popular a few years ago. So, is RBI a good investment? Are they worthy of blue chip status, perhaps? That is a good question, and before we can answer it, we're going to need to check in with our favorite numerical chef, Mr. Math. We will start, as usual, with, of course, a little bit of surface data. They've got a market cap of a nice, huge $31.33 billion. Their beta is pretty much as average as it can be. It's at 0.99. Their earnings per share come in at 0.61. And then we've got their price to earnings ratio. That comes in at 23.50, which is a little high. Actually, the average in their industry is 17.60. This does look like they may be overvalued, but we also know they are expanding, and that can inflate a PE ratio. Let's look at that price to book ratio. That comes in, oh boy, a little high, 9.20. The average in their industry is 3.3. Okay, now we have 2 points saying they may be overvalued. That may be the case, but we do, of course, need to keep their expansion in mind, as it can be skewing these numbers a wee bit. When we look at some of the cash, their revenue comes in at $6.64 billion, and that's pretty healthy. They have earnings of $1.01 billion, and those earnings are projected to grow by 11.76% per year. In fact, last year they grew 20.4%, which is not too shabby. Their free cash flow, they've got some good money on hand, $1.24 billion, and they've got a pretty healthy looking return on equity of 41.69%. Of course, that question of whether they're overvalued, let's try to answer that right now. Their current value comes in at $100.68. With a discounted cash flow model, we get a fair value of $79.18. That puts them at overvalued by 27.2%. Yikes, that is a little bit high. The fair value, it's also indicating that they are overvalued. So they definitely are, though I think the 27% may be skewed a wee bit. Let's just switch to returns. When we look at their dividend, they have a dividend yield of 2.96%. That is paid out quarterly in the amount of 55 cents USD per share. Their payout ratio is sustainable at 66.36%. If we look at the last 3 years, their share price has grown from $72.13 to $168. That gives us a return on investment of 39.58%. Add in those dividends, and we get a total return of 48.48%. When we look at the 1 year, in the last year, their share price has risen from $63.63 to $100.68. That is a return on investment of 58.23%. Factoring in the dividends, we get a total return of 61.65%. That looks pretty good. With 2023, this year, their their share price has gone from $88.46 to $100.68. So that's a return on investment for 2023 of 13.81%. Add in the couple of dividends they've received, and that's a total return of 15.06%. Overall, I'm really not surprised by their returns. Even when times are tough, fast food is still a consumer destination. I do know people who are currently eating more fast food because the price of making food at home has gotten just that expensive to make fast food a more feasible option, at least financially. Maybe not so much on the health side. Let's take a look at their debt. They have a total debt of $12.92 billion. This is a lot of debt, but not that unexpected when you take into consideration their expansions. Their total equity, that comes in at $4.31 billion. This gives us a debt to equity ratio of 299.6%. This debt to equity ratio makes me cringe a wee bit. This value has increased over the last 5 years as well, from 279% to 299.6%. So their debt is not moving in the right direction. A wee bit of a saving grace, though not much of one, is their cash and equivalents. That does come in at $1.03 billion. So they do have some cash to work with. Let's look at their short term. Their short-term assets come in at $1.89 billion, and their short-term liabilities pretty much the same, $1.88 billion. On the long-term scale, their assets come in at $20.63 billion, and their liabilities come in at $16.33 billion. So those don't look too bad. In regards to the overall debt situation, I am not happy that their operating cash flow cannot cover that debt. But sometimes this is the price of expansion. On the bright side, their interest on that debt is covered by their EBIT, so their earnings before interest and taxes. Okay, we've looked at the math, so what is that final verdict? Firstly, I did ask if RBI could be considered a blue chipper, and that is, well, it's a small yes. They are massive, and despite the debt, they are stable, and I expect they will be around for a very long time. But what about investing? Are they a good investment? This answer will depend on your investment goals. If you are looking for short-term gains, this will be a good middle-of-the-road stock for you. You will have some growth and some dividends, so total return is the play here. For mid to long term, there is opportunity for bigger growth, especially if they begin working on that debt. This is not a bad investment to buy and hold for perhaps even a decade or two. The debt for me is their biggest stumbling block, but it does make sense with their aggressive expansion. The other warning sign for me is that there has been a good amount of insider selling this year. Not enough to be worrying. I guess that is the story of this stock. There is some bad, but it is understandable, and when push comes to shove, there is much more I like here than dislike. So of course the final answer is all going to be what your due diligence tells you. I do like this stock, but always do your research before you throw your own hard-earned money on the table. Keep the learning going. Watch my video on CP Rail, linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner. See you in the next video. They've got earnings of $1.01 billion. This is not a bad investment to buy and hold for a century or two. I meant decade.